You're listening to a CNA podcast.
Hey, what's up, everyone? This is Andrea Heng, and welcome to the Money Talks podcast. This is where we talk about everything there is to know about personal finance. I want to take you back to an episode of Money Talks where we got to ask about entrepreneurship. David Gunn, he's the co-founder of the Tipsy Collective. Remember him? This is what he had to say about what it was like raising funds for his business.
When I first started Tipsy back then with my late partner, we tried to approach the banks for loans.
Right.
Absolutely no banks will touch us, by the way. They always ask, what's your track record, how long your company has been incorporated. So more than often, you'll be tapping into your own personal credit line.
So what David said got me thinking about how entrepreneurs raise funds. Now, aside from all the government grants offered in Singapore, there are a number of sources you can tap on. One of those ways is through angel investing and venture capitalism. But what is the difference and which one works better? So I would like to tackle this chat by asking 3 questions: the scenarios that call for an angel investor versus a venture capitalist, the pros and cons of either route, and what happens if your company goes bust after all of that money is raised and spent. And the one in the hot seat to answer them is Vanessa Ho. She's co-founder of Fintech Nation. She's also advisor to NUS Alumni Ventures. You might also have seen her on The Big Spark on CNA. Welcome to the Money Talks podcast, Vanessa.
Thanks for having me, Andrea.
All right, so the majority of us are salaried workers, right? But we've heard of 2 terms, angel investors and venture capitalists. You are in a unique situation where you're involved in both. So, using a simple analogy, describe the biggest difference between the two.
I think people talk about your first fundraising round like raising from the 3 Fs: friends, family, and foes. Angel investors are not too far away from friends, family, and foes.
Okay.
If you want to compare angel versus VC, angel investing in one stock, like an Nvidia stock or a Microsoft stock. VC, like a mixed portfolio, like a mutual fund or an ETFs. Or this is very relevant to myself, is as an angel, it's like being a social media creator. You can do anything you want. You can post any content, invest in any sort of things. You don't have a structured mandate where, you can only do this amount of content and this brief. And then some things may go viral and then some things just fail. But being a VC is like being a TV actress or a movie actress. You have to follow a certain branding guideline, just like your investment mandate. You have a certain structure to do it, and you can expect stable returns because your TV and movies will do at least X amount of reach and awareness. But you may or may not get the moonshot opportunity like the angel investors.
Okay, that's a really interesting way of putting it. So when it comes to picking the company to invest in, how different is the strategy for an angel investor compared to a venture capitalist?
Most angels that I meet, because of my work at NUS Alumni Ventures and Fintech Nation Fund as well, they don't exactly have a clear strategy in terms of investing. And even for myself, I know what I can do better in and what I don't, but it's not so much a formula. I invest in things that I understand and I can value add in as an angel investor. Essentially, as an angel investor, especially when you become more prolific, you can have decks coming to you every single day. And out of hundreds of deals that you see in a single year, and even if you have the time to do so, how do you pick the few that's going to make it?
Exactly.
And the hit rate or the pick rate, right, is like we do maybe 1 deal out of 50 decks that we see.
Wow.
And out of all these, say, example, if you invest in 20 or 30 startups, and maybe only 1 or 2 will be moonshot. And by moonshot, 100x and above.
Wow.
So the probability of a startup really giving you returns is very low, and you are expecting that 1 or 2 to carry your whole portfolio. Everybody else will tank, they'll go bust, and that one big potential unicorn is going to carry the rest of your portfolio and give you quite crazy returns.
Right. My primitive understanding of it before is that angel investors, they tend to gravitate to companies or startups that they feel a personal connection with. Does that happen with you as well?
Yes, correct. like if you are maybe a C-suite in a bank, for example, and you invest in fintech companies, it makes a lot of sense because firstly, you know what the founders are talking about and you know as well, even better than the founders, they're not gonna tell you about some product or strategy that completely doesn't work. But if you're in an entirely different field, how are you gonna analyze and be like, okay, this is the right startup that's gonna do well?
Right. So it's about comfort zone, familiarity at the end of the day.
But at the same time, even as an angel or VC, you make bets in sectors that you don't understand.
Right.
For example, we invested in a health tech company, even though we're a Fintech Nation fund.
Right.
But the co-founders, we really like them. And the other partner at the VC know them since they were like 18 years old.
Yeah.
So that's pure founder bet because they're great people. They've proven success, great track record. We may not know the product. They're pre-product, pre-revenue, like basically just a deck. But we really like them. And the bet is really on that person.
That's a great point. How much is a startup owner's personality, character, how much do these weigh on an angel investor or a VC's decision-making process? I mean, it sounds like it's pretty significant.
I think any early stage company, which is like Series A and before, you're looking at valuation of say under 30 million or 40 million. It's all about the people because the product's going to iterate and the startup idea might pivot along the way.
Right.
And we're looking out for three main character points, right? One is the team dynamic and the product and team fit. Are these the two or one best co-founders or founder that is going to tackle this problem and solve this problem? Maybe because of a domain expertise, or maybe they're driven by a certain purpose or problem they're facing themselves that they would sacrifice a lot of things to solve this problem. That's one. Second is character and values. In one of the previous VC that I was working at, we pulled off a deal because the founder of a automotive tech company started being a bit shady, started hitting on some of the investment analysts.
Oh dear.
And it's such a bad reflection of character. If this is your values, what are you going to bring to the table when you deal with your business counterparts or future investors?
Exactly.
And then the last bit is, I think, signs of operational and executional capabilities.
Right.
Right now, a lot of founders are excellent speakers and salespeople.
You can train to do that now.
Yes.
It's so easy.
Exactly. And I think one thing that the CNA show, the Big Spark producer, was saying that you cannot confuse eloquence with competence. A lot of founders can talk and pitch really well, raise a lot of money, but can they actually get their hands dirty and get things done?
Yeah.
So I think these are the three things we look out for in
Right.
founders.
So you can talk a big game. At the end of the day, it's whether you can walk the walk and talk the talk.
Exactly.
Essentially. Are you then expected to learn how to pick out these characteristics, how to identify them?
It's more complex than it seems. And I think the very senior, experienced investors know how to spot that. They've just met thousands of founders and they know how to spot like red flags. Same thing in a relationship, right? If you date enough, you probably know some of the red flags based on past experience and being burnt before. But for me, I rely a lot on my network to do reference check before making any decision. The due diligence process can take a few weeks.
Right.
And I just ask industry friends, what do you think of this person? How is it like working with this person? And basically seeing mutual connections that we form along the way.
Yeah.
So that has really helped. And I think it's really important to build industry friends and connections to protect yourself.
Oh, yeah. What about the involvement, the activity level that an angel investor versus a venture capitalist would have once that company has been chosen and you're investing in it?
I have seen like a spread of investors, both individuals as well as VCs, who have been hands-on, and those have just gone silent just because they're busy maybe building their own businesses or they have their own corporate jobs that have occupied most of their time.
So there's no hard and fast rule really for this.
Correct. There's no expectation when you invest, but of course it's a good value add. I have seen best practices from companies who constantly check in with the investors. It shouldn't be like, the investors coming in to support you and advise you because they're not employees. But the founders should be proactive and reaching out and be like, okay, hey, I'm thinking of this new product idea. What do you think of it? Or can you connect me with this person? Or I'm penetrating Australia. Can you connect me with some ecosystem players there? And usually no one says no. I think it's more like understanding the angel investors, their network, and their expertise. And same thing with the VCs, working very closely with the partners of the VCs who have the most resources and knowledge. And also in some of the bigger VCs, they have a portfolio management team who can provide a lot of resources to the startups as well.
Next up, we talk about the pros and cons of taking either route as a startup owner. All right, so now from the perspective of an entrepreneur, that's what I want to delve into now. We want to determine who we should approach for funds, right? As you said, an angel investor works quite differently from a VC. So give us the top pro and con of going to an angel investor.
I think from my own experience, angel investors, if you manage to raise from the right strategic one, they can give you referrals that will drive your revenue or even investments for your future fundraising rounds. The position of an angel investor is not just for funding, because a lot of times the investment check is small, maybe 10K, 50K, maximum 100K, but usually in the sub 50K range in Singapore. But they become your friend. They are the kinds who can provide you emotional support, especially when being a founder is so difficult, when you have to juggle the business, firefighting with competition, then the market. But with VCs, you have to obviously be more guarded sometimes, depending on your relationship with the VCs.
Sure.
And you only want to maybe show the highlights of your work and maybe not to get too personal, unless you become personal friends with, of course, the investment team at the VC.
Okay.
The cons is for sure, because the ticket sizes are smaller, it takes more time to raise. For example, if everybody's putting in 10 to 20K checks, you need a lot of them. And it's harder to manage so many people, especially when one or two angels can be very demanding, asking for a lot of requests or like unfavorable terms when the ticket size is tiny. So it's people management. That's the con.
How would you know if your angel investor has those capabilities that you need, has the support system that you need to get by, really?
I think before taking money from a angel investor, if you're taking it directly, get to know that person in one-to-one over coffee or dinners. Firstly, not just for the expertise, which is usually very clear. If you can Google them, maybe they're a top researcher or a doctor that can help maybe your medical tech startup. That's awesome. That one is undisputed. But maybe about their personality. Are they like very overbearing? Are they going to tell you XYZ instructions when they invest, even though they put in, say, 20K check? So get to know whether they're like the kind who's going to be too intrusive or overbearing, and you don't want that as well. Or the kind who's going to invest and just disappear. That is also maybe the kind of investors you may not want if you want more strategic value.
I think it also depends on what kind of person you are as a startup business owner, because it depends, I guess, on what kind of engagement you are expecting for yourself, right?
Yeah, it varies. But the other alternative is we see a lot of angel networks who can lead the round, right? For example, NUS Alumni Ventures is one of them. And then we have other angel networks in Singapore as well. Bansi, one of the oldest Southeast Asia angel networks. There's XA Network and many other angel networks. And there's one angel lead where the angel network verify and curate all these angel investors before letting them co-invest with them, and even do the legality, the term sheets, the structuring for you. It makes life simpler. Of course, the angels pay a certain fee when it comes to that, but the founders basically get the same thing. And usually these angel syndicates can pull together money which is like 100K to like even up to $1 million altogether, and basically save you all the hassle.
Right.
And also do some sort of like reference check of the investors before letting them in the pool.
Oh, that's interesting. And that's really helpful as well for someone who's just starting. So now I want to talk about the VCs. What's the biggest benefit and the biggest downside to seeking funds from a venture capitalist?
The most obvious benefit is that ticket sizes are generally bigger, so you save a lot of time, but the due diligence process can be months. VCs, you have a long stringent process, there's audit process as well, but then when you get a certain check from them, it's maybe 100K to a few $1 million, like $5 million, $10 million as well. So it fills up the round, and then that's it. You don't have to go around picking up small tickets as well. Second is VCs come with a lot of branding.
Right.
If you can raise money from the big guys like Sequoia's, your A16Zs, your GGV Capital, that branding of having that VC in your cap table already alleviates your status and your credibility, and it helps you even get clients because they're like, wow, you're GGV backed, you must be really credible and awesome team. It helps the subsequent fundraising rounds. It helps you get subsequent angel investors to fill up the rest of the rounds, and also for clients, which is the most important.
Indeed. Here's the thing. We see a lot of people online claiming to be VCs, claiming to be angel investors. Sometimes they are even among our own social circles. How do we verify if this person is legit? They have this money, they have these expectations, and everything matches up. How do we know that this person's for real?
I think three things. One is, honestly, anybody can be an angel investor. As long as you get some spare cash, you can angel invest. In Singapore, there is a law where you have to be a accredited investor to angel invest directly.
Right.
But there are different vehicles and means to do it, especially when maybe a company is not incorporated in Singapore. Then it doesn't apply directly. So if you don't take it too seriously and you find some value in that person and that person is not shady, an angel investor is just anybody, any individual who has the interest to invest and has the money to invest. I typically recommend founders to not take checks below 10K. It's too complicated. Anything above 10K, the guy is probably vested enough to support you and it doesn't make things too messy on the corporate finance level. Second is to work with a great corporate secretary company that can help you with the compliance and the KYC.
What's KYC?
Know your customer.
Okay.
We work with Sleek, which is also a portfolio company from the past, to basically verify the identity, bank account details of all these angel investors before a company takes money. So that basically comes in and then they do all the legal work as well, which saves you a lot of time.
Okay.
So finding the right CorpSec to do it is important. And the third is definitely reference check. If you've never heard of this person and this person wants to wire you $1 million, you have to start wondering, how did this $1 million happen? If this person's not on Google, not on LinkedIn, and have magical money appear, don't touch it because your bank account's going to be frozen and you're going to be so stuck.
Oh, yeah. Coming up, what happens when you spend all that money and your company doesn't make it? Okay, so Vanessa, I want to talk now about expectations. Angel investors and VCs are not giving away this money for free like Oprah does with her cars to the audience, right? So given the careful consideration that angel investors and VCs take to fund a company, what kind of returns do they actually expect?
Angel investors are probably expecting 1 or 2 out of their massive portfolio of even small portfolio to really make it. And that's like the 50x, 100x kind of returns, and the rest tank. Because when angel investors invest, typically they're at pre-seed stage, maybe even pre-product, pre-revenue, early traction. It's not very conclusive yet whether this company is going to make it because it's just so new.
Yeah.
Maybe 1 year in the making, 2 years in the making. So they're just expecting that 1 or 2 moonshot to carry the whole portfolio. For VCs, it depends. In early stage investments, say pre-seed stage, Series A, we expect a few moonshots, but then the rest may potentially fail.
Right.
But when it comes to, say, VCs that invest in Series B onwards,
Right.
larger funds especially, they're just happy with maybe a 5-10x return.
And does that have to do with the maturity of that company as well by that stage?
Yes, exactly. The maturity reflects the valuation of the company, which is like the price.
So from an entrepreneur's perspective, I could go to either an angel investor or a VC, right? Or both, especially if I know that they are keen to fund a business like mine. What's the key difference in how I should pitch to either one of them?
I don't think it has to be too different. Your pitch deck should be tailored to the individuals that you're speaking to. And also it should be concise and you should sell yourself, especially if in early stage. It's really about yourself when you're pre-product. When you're at the later stage, maybe sell your numbers and your traction as well, and yourself and your capabilities. But at the end of the day, the people deciding between VCs are also individual people. So know who you're pitching to. If they have technical expertise, maybe they used to be an engineer or a developer in the past. Maybe highlight the technical moat in your product. Well, we have the best developers, we have the proprietary tech and codes, versus maybe someone who is always in the back, then maybe show your projections more and how well you've calculated your financials and done your projections.
Right.
So everybody, whether it's a VC or an angel, they are also people.
So if my company goes bust, what happens then to the funds that I've taken from you or from a VC? Essentially, what's my responsibility with those funds then?
What happens when a company goes bust is there are probably assets that can be liquidated.
Okay.
Maybe some property or assets that the bank will liquidate. And then with this X amount of balance cash left, you have something called the liquidation preference. And in every agreement that you sign, whether you're an angel or VC, it will show you the order where the money will be dispersed.
Right.
Say, example, you invest in the later stage. For example, you might get your money before and after certain other investors. So do check that. And sometimes there's liquidation preference where you might get maybe 2x of the amount you invested in first. And it's usually prorated across. But the sad part is the founders always get the money last. They can work the hardest. They spend most blood, sweat, and tears in this, but the investors get their money first before the founders, which is very unfortunate. And then when it comes to loans, just check in your agreement whether your loan is more senior than other loans in the past, which also means whether in a repayment scenario, do you get your payment first or other lenders first. So everything has a certain sequence and everything's in the term sheet. I do advise basically every founder and investor, right, to get a lawyer or a legal friend or someone who knows the space to check the term sheets very carefully before signing anything.
Okay. So let's wrap with a summary, Vanessa. First, it's important to know who your target audience is because a VC has quite different priorities than an angel investor, depending on who and what kind of check size you're expecting. Number two, it's important to know as much as possible about the party you're getting your funds from. That way, you know how to pitch your idea the right way and strategically too. And number three, just in case things don't go according to plan, generally it's a good idea to have an exit strategy in mind in terms of trying to figure out what happens to those funds and what your expectations are when there's a dissolution. So, Vanessa, before we let you go, we have a segment. It's called Questions from a Hat. And you'll have to pick a question from here and hand it to me and I'll read it out to you for you to answer. Oh, this is a good one. Vanessa, if you could have a meal with any public figure, dead or alive, who would it be and why?
Wow, good question. I think I would probably want to have a meal with Jeff Bezos.
Wow, okay. Amazon guy.
Yes, I think he basically went from a small company to a huge share of the S&P 500, which is insane. I don't know how he does it. I want to learn entrepreneurship skills from people like Jeff Bezos.
Yeah, I think it's a certain kind of courage that they have. Vanessa, you've been such great company. Thank you so much for being on the podcast and just offering such sound advice for budding entrepreneurs out there. We really appreciate it.
Thank you, Andrea. Maybe next time you can invest in a media tech startup or
something.
something.
Very tempting. I'm going to have to think about that. Really exciting world, but not for the faint of heart. I'll tell you that. And listener, if you have any thoughts or questions about this episode, all you got to do is send us a message. Money Talks is streaming on Apple Podcasts, Spotify, and YouTube Music. Rate us if you are enjoying our content. My thanks to the team, Crispina Robert, Tiffany Ang, Junaini Johari, Joanne Chan, and Saye Wind. I'm Andrea Heng. This has been Money Talks.